Hey everybody, welcome to episode number 11 of Migrate Your Money. I'm your host, Drew Fights, certified financial planner and founder of Migration Wealth Management. And today I want to talk to you about tax implications for S Corp business owners. So let's dive in. If you're a business owner who takes W-2 wages from your S corporation, that may not be your only taxable income. An S corporation, or S Corp for short, is a pass-through entity for tax purposes. What does this mean? It means that the net profit generated by your S Corp is not taxed at the corporate level, but instead it passes through to your personal tax return. However, this pass-through feature can sometimes catch business owners off guard when it comes to calculating their taxable income. Something that I find that's commonly misunderstood by business owners is that net profit from your LLC or S Corp passes through to your personal tax return. Many business owners who take W-2 wages from their S Corp assume that's their only taxable income. However, if your business income is profitable, that's far from the truth. This net profit that we're talking about is the remaining amount after deducting your business expenses and after paying your salary. And it represents the earnings that are going to pass through to your personal tax return in addition to the salary that you paid yourself. So let's talk about how taxable income from an LLC or an S Corp passes through to your personal tax return. Let's say your business is an S Corp and you pay yourself a W-2 wage, but the business also has net profit at the end of the year that either remained in the bank account or that you paid out to yourself as distributions. Both the W-2 wages that you paid to yourself as a salary and the business's net profit pass through to your personal tax return. On a 2022 Form 1040, if you look at line 1, that's where W-2 wages go, just like any other employee. But what I find that many business owners get confused about is that the net profit of the business goes on line 8 of your 1040. And then on line 9 of the 1040, both of those income items, as well as any other income or losses that you're reporting, are added together to calculate your total income. This total income is then used to determine your tax liability. Whether you pay yourself a W-2 wage or not, Uncle Sam's going to get a share. So if both your W-2 wages and net profit from your income are taxable, why would you elect for your business to be taxed as an S Corp? The power behind making an election for your LLC to be taxed as an S corporation is the ability to avoid some self-employment taxes. Without going off on too much of a tangent, it's important to explain self-employment taxes at a high level to help understand the concept of why you may or may not want to make an S Corp election. Self-employment taxes consist of Social Security and Medicare taxes, which are commonly referred to as FICA taxes, or Federal Insurance Contributions Act. As a W-2 employee of a business, you're subject to paying 6.2% of your wages into Social Security taxes. In 2023, the wage base limit for Social Security taxes is $160,200, meaning that's the most amount of your income that you would be subject to pay Social Security taxes on. Additionally, you're subject to paying 1.45% of your wages into Medicare taxes and an additional 0.9% Medicare tax on wages above $200,000. Your employer pays another 6.2% of your wages into Social Security and another 1.45% of your wages into Medicare. So as an employee, you're subject to paying FICA taxes of 7.65%, so that's 6.2% Social Security plus 1.45% Medicare, and your employer also pays FICA taxes of 7.65% on your wages. As a business owner, you're responsible for paying both the employee and employer portions of Social Security and Medicare taxes. So 12.4% for Social Security and 2.9% for Medicare, for a total of 15.3%. So why would you elect to be taxed as an S Corp? As I mentioned before, the power behind making the election to have your LLC taxed as an S corporation is the ability to avoid paying some self-employment taxes. To avoid paying some self-employment taxes using an S Corp election, you have to set a reasonable salary, which is not defined by any IRS guidelines, and then you can take other compensation as a distribution. The salary or W-2 portion of your income is subject to self-employment taxes, while the distribution portion is not subject to self-employment taxes. It's important to note that you'll still have to pay federal and state and local taxes if those are applicable to you on both the salary and the distributions. This is another common misconception that I hear from people who've made an S Corp election, is that they think that they don't have to pay taxes at all on their distributions, which is not true. The fact is that you don't have to pay self-employment taxes on your distributions, but you are still subject to income taxes. It's also important to note that as an S Corp, you should be paying yourself a W-2 salary. You can't just take all of your income as distribution to avoid paying self-employment taxes. Doing so is illegal, and it'll end up costing you more in taxes and penalties if you're ever audited. So, should you choose S Corp tax status for your business? Whether or not you should choose S Corp tax status for your business is a nuanced discussion that you should have with your tax professional. And to be clear, we have not discussed all of the considerations of making that decision today. Not only do the tax implications need to be considered, but you also need to factor in the cost of making an S Corp election, such as an additional tax return, payroll, accounting fees, etc. Not to mention your long-term goals and how S Corp taxation may or may not be beneficial to achieving them. I hope this has shed some light on an important aspect of taxable income that's often overlooked by business owners who take W-2 wages from their S Corps. As we've talked about, navigating the intricacies of business taxation can be challenging, but having a firm grasp on tax implications of W-2 wages and net profit is essential. As a business owner, it's crucial to recognize that both forms of income contribute to your overall taxable income. By properly reporting and understanding how these incomes affect your personal tax return, you can ensure compliance with tax regulations and avoid potential issues with the IRS. As always, it's advisable to consult with a qualified tax professional to ensure you navigate the complexities of taxation smoothly and to make sure you don't get yourself in trouble. That's all I have for you today. As I mentioned at the beginning, my name is Drew Feitz. I run a fee-only wealth management firm called Migration Wealth Management that specializes in providing financial planning and investment management to people in their 30s and 40s. If you're interested in learning more, check out my website at migrationwealthmanagement.com. I've tried to make it really easy to learn more there. And if you're interested in scheduling a 1-hour intro and discovery meeting with me, then you can find a schedule a free meeting button at the top page of every website. Thank you for joining me today, and I'll see you next time.
This podcast is for informational and entertainment purposes only and should not be relied on as basis for investment decisions. None of the information provided in this podcast is intended as investment, tax, accounting, or legal advice.